Hi everyone, hope you're all doing well. Today I'm going to talk about the 4 stocks that I've been buying over the last 2 weeks. Sorry I've not updated you a little bit quicker. Normally I update you every week what I'm buying and selling, but with what happened last week just meant that I haven't been able to update you. It's just been a crazy week with earnings. Obviously we've had the situation with Ukraine and Russia that's been going on, and I've just been talking about them rather than what I've been buying. So yeah, these are the 4 stocks that I've been buying. I bought some of these stocks last week and the week before. So yeah, just to keep you guys updated with what I'm buying and selling, you know, just keeping that transparency up and being honest with the moves that I'm making in the stock market. So hope you enjoyed it. If you could, hit the like button and we'll take a look. And if you do want to know when I'm buying and selling companies in real time, make sure you join the Patreon, link is in the description, and then you don't have to wait 2 weeks for me to update you with the moves that I'm making. As well as that, there's a Discord with 600 members to talk to on there. You can also talk to me on there, and also there's 2 exclusive videos a week, and it's £5 a month, which isn't too bad. And we'll take a look at these stocks. So number 1 had to be on this list is Boohoo, especially with how it's carried on dropping. I think this last 2 weeks I've actually bought quite a few good diverse amount of companies. We've got Boohoo here, we've got another big tech company in here, a company that's another company that's profitable, and a dividend stock. So here's a good mix and match of stocks on here. 2 UK stocks and 2 US stocks. But yeah, number 1 is Boohoo. So Boohoo has had another ugly kind of month. In January it's carried on down trending off, should I say, February. You know, it lost 20% more in February, and once again I'm just kind of looking at this one going, it's unbelievable. Like, you know, if we go back to here, you know, I'm going to do actually probably a video about this in probably tomorrow, unless anything crazy happens during Monday. But, you know, I've seen so many people, you know, I saw, you know, through 2018 to 2019, there wasn't that many like negative comments on Boohoo. And through 2019 to 2020, you know, when the stock was going up 92%, you know, there was no negative comments on Boohoo. And same again, if you bought in these dips here, which I was doing, you know, and I sold for a good amounts of profit. You know, there's times here that we were taking 50% profit. You know, I saw no negative comments on Boohoo, and I saw no one really kind of questioning the business model. And what's happened now is that suddenly the share price has lost 76%, and I'm seeing so many people crawl out the woodwork and go, oh, Boohoo's a terrible company, oh, that's going down to zero, rather than looking at going and thinking, okay, this is at the historical low valuations it's ever been at, it's lost all much this value, rather than thinking, oh, you know, it's a terrible stock, you don't be touching that, rather than thinking, okay, maybe this is a buying opportunity because you're at previous prices, it's been a brilliant stock recently, and for some reason overnight in the last 12 months, because the share price hasn't done well, apparently now it's become a terrible company, and people aren't looking and thinking, okay, maybe it's had some problems, maybe it deserves to have a bit of a bumpy share price, maybe it deserves to lose 10-20%. Does it deserve to lose this much? Does it deserve to, you know, from here lose, you know, 76% of its value? And at the moment, you know, it's trading down at, you know, 18 times earnings, and it's like, you know, this isn't your average company. We're going to talk about this. You know, this is your company that's going to be growing 20-30% in revenue growth. You know, that's a massive, you know, that's so much more than your normal, you know, company that trades down at 18 times earnings. You know, 20-30%, you know, these sort of companies normally trade at a premium, and at the moment this is below a premium, which is absolutely unbelievable. You know, it's currently trading down at 1 billion. Now, I'm not going to spend too long on Boohoo because I've covered it so many times on the channel, so if you want a bit more, you know, detailed videos, I've got plenty out there. But Boohoo, they've gone from just being the one range, which is Boohoo, they've added also, like, you know, Pretty Little Thing in here. One of the recent purchases that I do really like is they've acquired Debenhams. Debenhams will obviously give them a bit more of a extended age range. So, you know, Boohoo normally have gone, I would say, probably around that age range of, you know, 16 to maybe, you know, 25. That's probably the primary age. But the Debenhams kind of now lets them into that category above that age bracket. A bit more of a, I'd say, more expensive brand, so obviously that will command better margins, what Boohoo has previously ever done, and also it extends them into beauty. So rather than just being a fashion company now, a beauty company, and this is only just being relaunched in October 2021, so we're only going to start getting some of these sales coming in through the back end of 2021, but 2022 will be the first kind of year that Debenhams will be relaunched under the Boohoo's name, and hopefully that does well. Now, same again, just on a metrics point of view, this is what I mean. You know, people looking at this company going, okay, it's got a few problems and it deserves, you know, a drop in share price. Does it deserve to have this much drop in share price? And my opinion is no, and this is why it's a, you know, really good opportunity. You know, for me, I've never thought, you know, buying Boohoo at a £3.50 range has always been, you know, you don't buy it at £3.50. In my opinion, then you are kind of, maybe not like a cheap valuation, but you are paying a fair valuation. But when you start talking about Boohoo below £2.50, especially at 80p, that's when I start going, that's where it's, you know, so cheap to buying up this stock. And if you look at the historic metrics, you know, if you look at the forward multiples, the revenue at the moment is a 0.7. Previously, you know, it's always been around about a 2. If you look at the price to sales ratio, 0.7, always been around about a 2. If you look at the EBITDA, it's currently a 10, and previously, if we go here, you know, 19, 20, 20s, 28, 31, and I won't bore you with any more metrics, but you can see here, these metrics are, you know, under half what they normally are, which is unbelievable. Now, from a historic point of view, this company has always grown its revenue and profit in the right direction, and it is going to have a bit of a slowdown in earnings as some supply chains issues kind of hit the company. But when they kind of resolve and the company carries on growing at the rate it does do, which, you know, 20-30%, sooner rather than later, I think Boohoo will hit up doing about 100 million back in profit. And then these sort of valuations, you know, you're talking nearly 10 times earnings, which is absolutely ridiculous. And like I said before, Boohoo's going to continue to grow probably 20 or 30%. If you look at historic growth, you know, it's got a track record of absolutely doing that. Financial health wise, it's an amazing company. You know, there's not much debt to equity, there's about 10% here. But you look at the cash that they have on the balance sheet, even after buying a lot of brands at the moment, it's still sitting on 148 million cash, 50 million in debt. And there has been a couple of insiders buying, no selling, which is probably an important bit. And as well as that, the actual co-founder and the chairman of the board, Mahmood Kamani, has a 16% ownership. So he's the biggest owner of the company, which is always good to have some skin in the game, I guess. So that's number one. Number two is PayPal. So PayPal is my newest stock into my stock market portfolio. Didn't really have too much interest in PayPal because I always thought it had gone a little bit overvalued. But recently, as PayPal has gone really sub 150, which happened really off one earnings report, I kind of got to the point of view where PayPal's now back at really good valuations. PayPal obviously is a well-known company. You know, it's 129 billion. It's obviously for online money transfers, and obviously one of the big things it owns is Venmo, which is a massive growing space, especially when their partnership with Amazon starts kicking off this year. Well, this company was, the 52 Kai says $310, and same again, this stock has lost, 64%. Once again, I look at this and think, yep, you know, $300, this was massively overvalued, but now you're at $110, I'm thinking, this is a bit of an overreaction on the sell-off, and I'll be happy to buy some shares here. Trades at 31 times earnings, and if you look at pre-CV situation, it is actually below pre-CV prices. So it's nearly had, well, it has had no share price gain in the last 2 years, basically, which is absolutely bonkers. Because when you look at the financials in this 2-year time frame, so much more profit, so much more revenue, and it's getting valued less than what it was pre-CV, which is crazy, and that's why I'm buying this one up. Now, the major dip happened on PayPal because of its forecast. Its forecast was a little bit lower than what was expected. So they are now going to expect revenue to grow 15 to 17%, which is still massively good. You know, that's more than your average company. And I think the expectations was something around about like 18 to 20%. So the decrease is hardly that much, and it is going to be a little bit less on the profit side as well. But for me to have like a 10% decrease on revenue and profit, and then to justify going to share prices below CV times, was absolutely bonkers. 31 times earnings, once again, you know, when you're considering this is nearly double-digit growth company, and at the moment it's overlapping really hard comparisons because it's losing a bit of that eBay business. As soon as that goes out the window, this company will probably go back to 20% revenue growth. Obviously, the profit will start moving back in the right direction. And I think at 30 times earnings, this is not too bad at all. And same again, on a metrics point of view, you can see this stands out as being historically very cheap for this company. And once again, you can see the past history of the amount of growth this company has revenue-wise, profit-wise, you know, 20% margins, which is absolutely fantastic as well. And what that has led to is the company having a pretty decent balance sheet. It's got 41% debt to equity, but if you look at the debt, it's got 9 billion and the cash is actually 9.5 billion, so it's off in one go if it really wanted to. And one of the really big bullish signs about PayPal recently is that there has been a lot of insiders buying, which is obviously a positive. Moving on to number 3, which is Callaway Golf. So I did buy some more shares in Callaway Golf, first time for a while. I just got to the point of view where I was like, I've not bought this one for quite a few months now. I'm just going to top up my position in this one, and I did this after they reported their earnings. So I look at a company like Callaway Golf, very much like a lot of companies out there. You know, it's not a coincidence that there's all these companies that have done basically nothing for 12 months. It's just the stock market that we're in. And Callaway Golf's one of them. You know, since February last year, what's the company done? It's actually down 20%. And if you look at what Callaway Golf's done in the last 12 months, the financials have just got better and better. And sooner rather than later, Callaway investors Wall Street will look at this and go, you know what? We need to be buying the shares, and it will move back in the right direction. And like I said, the financials have just improved on Callaway, but the share price hasn't reflected that. And sooner rather than later, that will happen with this company. Now, Callaway itself doesn't really interest me too much as a business model, you know, with the golf clubs, the classic model it had, but it made an acquisition last year, or should I say the back end of 2020, that got me really interested. They went and bought Topgolf, and I really like Topgolf. I was actually tracking it because I thought it was going to IPO, and I would have been very tempted to get into the IPO because the Topgolf business model is absolutely amazing. Now, the company itself, Topgolf, was rumoured to IPO at $4 billion, so when Callaway bought it for $2 billion, I thought that's absolutely fantastic. And then you add in the fact that Callaway has its classic, you know, golf club model, and kind of ties it to the golf company that sells basically everything and covers so many, you know, from the kind of golfers that take it a little bit more serious to the casual golfers that think, oh, shall we go down to Topgolf for an hour? Maybe they go, you know, once, twice, every kind of year. So I think this kind of covers so many industries, and they also have, I could, like I said, I've got a full video on this one, but I want to make it kind of quick so I don't spend 10 minutes on every company. But it's like the whole company now for the golf industry. And these Topgolf locations are fantastic. I think they're going to open up more and more as the years go on. And these Topgolf locations are going to really drive the revenue forward and also drive the profit forward in the next few years. Now, you can already see the jump in revenue with the Topgolf merger, and the profit could be in and out as they open up more and more venues. But this company now is going to go from a historic company that steadily grows you know, the revenue and profit to a company now that is going to really put in fantastic amounts of growth. You know, this company grows historically, you know, 3-4%. Now it's probably going to grow, you know, double digit up to 20% a year. And then you think about the profit that Topgolf locations are going to drive in. Total different business model from what it was, and just the complete golfing business really. Now, financial health wise, it's not too bad at the moment. It has been buying out a lot of companies, so that's why the debt to equity is a little bit not great, and the cash balance as well to the debt isn't absolutely amazing, but still I'm happy with the balance that is in there at the moment to buy the shares and hold this stock. And same again, in December there was a little bit of share buying in this one. The CEO bought some shares and also the CFO bought some shares, which is obviously a bullish sign. And looking at the metric side of it, same again, you know, this company's not, you know, compared to like PayPal and Boohoo, the company's not like cheap on the metrics, but it's at historic kind of averages. Now, when you add in that this company has had such a jump up in revenue and will grow a lot faster than what it does historically, that's what I really do like about it. So yeah, for me, Callaway Golf, Eli, I think this will be a nice 2x in the next kind of 5 years. And that's why I bought that one. And the last one, which is Catebox, I made a video on Saturday talking about this one, so go check my last video out if you want a little bit more detail on this one. But yeah, I couldn't actually believe like the negativity that video got. A lot of people saying how much of a sham company this is, you know, and it was just really surprising to me to see a company that, you know, grows profit, grows revenue, pays a 4% dividend yield at a very cheap valuation. And just because it's had a share price drop, everyone says it's like a bad company now. And it's absolutely bonkers to me, like how people have that mentality. And, you know, you look at this company here and look at this uptrend that it was being on. You know, during this uptrend, you know, I saw no one kind of being negative towards this stock, and all I saw were positive news to this stock and people going, oh, you know what, if this company was ever to have a dip, you know what, I'd buy more shares. And now this stock has actually fallen off, you know, as much as it is. People see that with fear, and people are like, oh, it's a terrible company, I don't want to buy that company. And it was like, hold on, but 6 months ago, people, you know, I saw a lot of comments on videos talking about it, and people going, you know what, if this was ever going to dip, I'd buy it. And now we get the dip and people going, oh no, it's a bad company, I don't want to buy it now. It's unbelievable, like the fear and negativity that I've seen out there in the last kind of few weeks, and on a few stocks that I talk about as well, which is crazy. Now, the differences with this company is that there has been kind of a reason why the drop has happened. Basically, some allegations came out saying the accounts were wrong, which Catebox admit, but it's just an inventory issue. There's no problem with profit and revenue. That would probably be the one where I'd be very worried if that bit was the incorrect part, I guess. The other part being that the auditor did move away from the company, but it sounds like there's just been a bit of breakdown with relationship, but they still signed accounts off and have replaced them. So from that point of view, I'm fine from that point of view. It needs to be better, but it's not something for me that I look at and think, well, in the last kind of, you know, 4 years, this company deserves to be flat on the share price. When you look at the profit and revenue growth, and the dividend you get, it's a pretty solid dividend stock really. So I'm happy to still buy the dip on this one. And like I said previously, you look at the performance of this company, decent profit margins, revenue growth's good, all moving in the right direction. Financial health wise, it's very healthy as well. It's got 11% debt to equity, 1.4 million in debt, 5.6 million in cash that could easily pay that debt off if it wants to. Pays a lovely dividend as well, and it has quite a decent ownership. It's a founder-led company. You can see here the CEO, founder, 25%. So if anyone's incentive to kind of get this company to do well, it's him, because this is probably where most of his wealth is tied up. So obviously that gives you a bit of confidence as well, that he owns such a big stake in it. So I hope you enjoyed the video. Those are the 4 stocks that I have been buying recently over the last 2 weeks. A good mixture of stocks, I think. So yeah, hope you enjoyed me sharing that information with you. If you found the video useful, hit the like button if you're new, subscribe, and I'll see you next video.